The CBOE Volatility Index, or the VIX, is one of the most widely followed indicators that traders, investors, and financial media refer to all the time. As a result, the CBOE introduced volatility indexes on a wide variety of markets. One of the most interesting markets for which CBOE calculates a volatility index for is gold. Joining me from the floor of the CME is Russell Rhoads, Senior Instructor for the CBOE Options Institute. Russell, explain GVC relative to the VIX and how one can use it with their trading.
Well, GVZ, it's a volatility index, much like about 30 volatility indexes that we publish at the CBOE, and it uses the same methodology as VIX, except it's based on options on the GLD, Exchange Traded Fund. It's basically a measure of 30-day implied volatility as indicated by option trading on GLD options, whereas VIX is based on S&P 500 index options.
So how would you use that in terms of trading? Can you trade options around it, or do you just look at it as an indicator to help you make decisions on the GLD?
Well, actually, it works both ways. GVZ is a great indicator, much like VIX is a great indicator as far as, I'll use the word panic instead of fear because it's a little bit different with GVZ. The volatility of gold options will actually move up if the price of gold moves up very quickly. We don't see that with VIX relative to the S&P 500. And gold volatility will also spike up, as we've seen a couple of times this year, when the price of gold goes down very quickly. GVZ is more of an absolute volatility type of indicator, whereas VIX has this inverse relationship with the S&P 500. It's also a way to measure whether or not options on GLD or gold options are cheap or expensive. Today, GVZ's in the low 20s. Just a few weeks ago, GVZ was closer to 30. Options are a little bit cheaper right now, and the strategy that an option trader may use is it's going to be partially dictated by that implied volatility component.
So GVZ was actually down 6% last week, and we've seen some inflows into the GLD, which is a trend that we have not seen in a while. Gold has really had a tough time of it over the past few months. So is this a good time to go in and buy, let's say, for example, you go on the GLD and buy some vertical spreads on it, because it seems like it's cheap to get in for some future movement?
Right. Well, it's definitely gold options or options on the GLD are much cheaper than they were just a few weeks ago, as you mentioned. If you're thinking about a long or a short position, you might be more likely to just buy a call option or buy a put option and not do some sort of spread when GVZ is 10 points lower than where it was at the end of May. As far as what GVZ is telling us about the future direction of gold, it's pretty interesting. We tend to, when you get a big move, we tend to see GVZ pop up as well. And back in April, we had this move where gold went from, and everybody's aware of this, from 144 to about 131 in a single day. GVZ popped up to 34.48. The next spike down, or maybe the last spike down that we got in gold, was toward the end of May. The GLD went down to, closed at 115 and change. GVZ only closed at 43, I believe. And that lack of confirmation that the downside is going to continue, actually, it was an early signal that maybe we had seen at least a near-term bottom in the GLD.
Okay, excellent. Thank you, Russell. For more on Russell's volatility analysis, you can check him out on the blogs like CBOE.com and the Options Institute.